Hello, good day. In this video, I'm going to introduce relative strength index to you. Among the momentum oscillators, the relative strength index is the least complex and easiest to interpret technical analysis tool. I will organize my presentation into two sections. The first section defines what is RSI and describe the basic features of RSI. The second section is about how to interpret RSI for investment decision making. In view of the length of the video, I would very much like to create another video in future about how to calculate RSI. Do watch out for that. At the end of this learning session, it is hoped that students will be able to understand RSI and apply RSI in technical analysis. Let's learn together. The relative strength index was originally developed by J. Wells Wilder in 1978. He has published a book entitled New Concepts in Technical Trading Systems. What is relative strength index? Let's define the concept. The relative strength index is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price. The RSI measures the strength of an issue against its historical of price change by comparing up days to down days. RSI may be called a smooth oscillator. It constitutes a price-based oscillator which conveys information about how strong or weak the price action has been over the period under consideration. From the figure, you can see that the RSI is a line graph that moves between two extremes and can have a reading from 0 to 100. The values from 0 to 100% in the RSI scale are highly useful to compare different situations, and it provides the possibility of identifying danger zones corresponding to overbought and oversold situations. Relative strength index is useful in determining overbought or oversold levels in the price of a stock or asset. It can be used as a confirming indicator for trend reversal in price. It may also serve as a leading indicator in cases where momentum precedes price reaction. Therefore, relative strength index is a valuable tool to uncover potential opportunities. However, relative strength index may also yield false signals, so it requires confirmation before entering new trades. What are the key assumptions of RSI? Wilder based his index on the assumption that overbought levels generally occur after the market has advanced for a disproportionate number of days, and that oversold levels generally follow a significant number of declining days. Be careful to understand that the RSI measures a security strength relative to its own price history. not that of the market in general. Because of its name, a common misconception is that this indicator compares one security to other securities. Let's learn how to interpret the relative strength index. In general, when the RSI is rising, the stock is outperforming or leading the market. When the RSI is decreasing, the stock is underperforming or lagging the market. The RSI can range from a low of 0 to a high of 100. The values from 0 to 100 in the RSI scale are highly useful to compare different situations, and it provides the possibility of identifying danger zones corresponding to overbought and oversold situations. 0 means no up days, and 100 means all up days. The central line of RSI is 50. When the RSI is above 50, the underlying trend in prices is usually upward. Conversely, when the RSI is below 50, the underlying trend in prices is downward. Some traders cling to above 50 to confirm bullish signals and below 50 to confirm bearish signals. The RSI constitutes an overbought or oversold oscillator. J. Wells Wilder recommended using 70 and 30 as overbought and oversold levels. If RSI rises above 70, the underlying stock prices show high upward momentum. This is an overbought signal. Investors should sell the stock. RSI above 70 is a bearish signal. The stock is overvalued and may be primed for a trend reversal or corrective price pullback. If RSI falls below 30, the underlying stock prices show high downward momentum. This is an oversold signal. Investors should buy the stock. RSI below 30 is a bullish signal. The stock is undervalued and may be primed for a rebound or corrective price upturn. Stock prices tend not to remain in the extreme level for long. This provides an excellent system for timing of reversal and for confirmation of other reversal signals. However, it is vital to bear in mind that if the RSI stays below 30 for a long period of time, then this implies that the signal can be false. In that respect, it is considered best to wait for a turn in RSI prior to entering any buying position. Analysts will often adjust the overbought and oversold levels based on the underlying trend. We may use 75 and 25, even 80 and 20 as the overbought and oversold extremes. In extremely bullish or bearish market, the overbought and oversold levels can be widened to reflect the extreme situation. Finally, we have come to the end of this video. I hope you have learned some knowledge from this video. If you like this video, please click like share or subscribe to my YouTube channel. Thank you. See you and goodbye.